Gold closed at 4,540. That was down about 2.3% on the day. Silver got beat up a lot more, down 8.5% today, closing at 75.84. I know that the bond market is losing confidence in the U.S. Treasury. The driver is the runaway debt and the inflation. And that is the best scenario for gold and silver. They are inflation hedges. If there's going to be more inflation, then that's good for gold and silver. If bond prices are falling, that's a sign that investors don't want to hold bonds. What's happening right now is not a reason to sell gold and silver. It is a reason to buy gold and silver. The people selling gold and silver, traders, speculators, don't understand that. Just like the people who were buying long-term U.S. Treasuries at 4%. But what's the most bullish for gold or silver is all the money the Fed is going to print to try to stop bond yields from rising. It was actually a big down week for gold and silver, but it was a big positive when it comes to the fundamental news that will be driving gold and silver prices much higher in the future. In fact, the news that we got today is pretty much exactly the news that I've been predicting that we would get, even though mainstream Wall Street advisors or economists had not seen this coming. And in fact, many were predicting the opposite. Everything is working out as I expected it to. And all of this works to the benefit of gold and silver. And so even though gold and silver prices were sharply lower on the day and then on the week, this is good news for people who want to buy more gold and silver, which of course is what I recommend that people do, especially in light of the news that came out this week that should have pushed gold and silver prices higher, but didn't, because the traders who control the short-term fluctuations of the market don't understand what's going on. Now, gold closed at 4,540. That was down about 2.3% on the day, and the weekly decline was 4%. Gold's still up, though, about 4.8% on the year, but a lot of its gains were lost temporarily, at least this week. Silver got beat up a lot more, down 8.5% today, closing at 75.84. Earlier in the week, in fact, yesterday, silver got as high as 89. We were about $1 away from 90. We closed almost 15% below 90. That is a huge move.
Markets celebrated falling metals prices while ignoring the exact inflation signals that historically ignite the next leg higher. Peter Schiff notes that silver collapsing nearly 15% from its highs while bond stress intensifies is not weakness. It is forced short-term liquidation, masking deeper monetary instability. Retail investors are reacting to price action, but institutional desks are watching deteriorating Treasury demand and rising refinancing risk. The real danger is assuming volatility means safety has disappeared when it may signal the opposite. Next, Peter Schiff exposes why bond traders are suddenly behaving like inflation is no longer controllable.
On the week, though, silver was down 10.5%, still has a 5% gain during this calendar year, but clearly most of the gain was lost this week, even though the fundamentals were a lot better when the week ended than they were when the week began, at least the confirmation of those fundamentals. The stock market shrugged off the bad news a lot better than the metals market. The Dow was only down about 1% today, and down maybe slightly, almost unchanged, but down slightly on the week. Still up about 2.4% on the year, so not quite as much as gold and silver. I know that the bond market is losing confidence, or the buyers of bonds are losing confidence in the U.S. Treasury, and they don't want to buy. And this is what's going on. And the driver is the runaway debt and the inflation. And that is the best scenario for gold and silver. They are inflation hedges. if there's going to be more inflation, then that's good for gold and silver. If bond prices are falling, that's a sign that investors don't want to hold bonds. They want to get rid of bonds. Well, what are they going to buy when they get rid of bonds? They'll buy gold and silver. Gold and silver are a safe haven from bonds because bonds are not a safe haven from inflation. Bonds get eviscerated from inflation. And if investors don't want their personal savings to be eviscerated, they get out of bonds and they get into gold and silver.
The Fed keeps promising stability while the bond market quietly prices in the opposite outcome. According to Peter Schiff, long-duration Treasury buyers are beginning to reject the assumption that inflation will normalize anytime soon, despite the media framing every dip in metals as a failed breakout. Stocks barely reacted because equity investors still expect rescue liquidity if conditions worsen. But savers trapped in fixed income assets face the real threat as purchasing power erosion accelerates faster than headline yields can compensate. Next, Peter Schiff reveals why rising yields may actually be the most bullish signal gold investors have seen in years.
So what's happening right now is not a reason to sell gold and silver. It is a reason to buy gold and silver. The people selling gold and silver, traders, speculators, don't understand that. Just like the people who were buying long-term U.S. Treasuries at 4%, for example, because they thought they were getting a great deal because the Fed was cutting, and maybe they expected rates to decline dramatically. Remember, at one point, the yields on those durations were under 1% in the early days after COVID. But those levels are likely never to be seen again. Even if the Fed does come back with massive QE, I don't think they'll succeed in driving long-term yields down to those lows. So the people who expected bond prices to rise and yields to fall clearly don't understand the implications of yields rising instead of falling. They think, oh, yields are going higher. We should sell gold. Why? What's so enticing? Yes, I could get 5.12% on a U.S. Treasury if I take 30 years of inflation risk. It's not worth it. Inflation is going to be more than 5%. You're going to have no return. You're going to have a negative return. I'd much rather own gold. And of course, these rising interest rates in and of themselves are going to increase the budget deficits because the government now needs more money to pay the higher interest. But it's also going to slow the economy by weighing down consumers and businesses that have debt. It's going to lead to higher mortgage rates. And that's going to diminish the revenue coming into the government and increase the expenditures going out.
A 5% Treasury yield sounds attractive until inflation quietly consumes the entire return underneath it. What Peter Schiff is highlighting is that investors are focusing on nominal income while ignoring the compounding fiscal damage created by higher government refinancing costs and slowing economic growth. The bond market is no longer pricing confidence. It is pricing escalating risk premiums tied to unsustainable debt issuance. For retirees and conservative savers, that distinction matters because negative real returns destroy purchasing power far faster than most portfolios can recover. Next, Peter Schiff unravels how rising deficits could force the Fed into another hidden liquidity cycle.
So that makes the deficits bigger too, which is also bullish for gold and silver. But what's the most bullish for gold or silver is all the money the Fed is going to print to try to stop bond yields from rising and the economy and asset prices from tanking. The only question is, when does the Fed cry uncle? I mean, they're already doing stealth QE. They're already buying short-term duration bonds. But what they really need to do is buy the long end. In fact, the U.S. government has been doing that. The U.S. government, in an effort to artificially suppress long-term rates, has been borrowing money from the Federal Reserve effectively by selling the Fed short-term rates and then going out and buying back through its Treasury buyback program the longer rates. This is the worst thing you could do if you're trying to manage, your fiscal situation, because you're retiring the long-term debt that you should leave out there, and you're taking on more short-term debt that's going to be problematic as interest rates rise and you have to roll it over. But, these yields don't even come close to compensating you for what you will lose to inflation if you lend the government money at these rates. And that's why the rates are going to keep rising, because bond prices are going to keep falling. And that is not negative for gold and silver. It's positive. The only question is, when will clueless investors figure this out, and speculators? I don't know. But you got to make hay while the sun shines. And that means, buy gold and silver while they don't understand what's going on, because this is a great opportunity.
The Treasury is shortening its debt exposure at the exact moment long-term rates are becoming structurally unstable. Peter Schiff's argument suggests policymakers already understand that sustained higher yields would detonate federal interest expenses, which explains the quiet reliance on liquidity operations and Treasury buybacks behind the scenes. Publicly, officials still frame inflation as manageable, while privately restructuring debt issuance like a crisis is approaching. Investors focused only on daily gold volatility are missing the institutional behavior signaling deeper stress beneath the surface. Next, Peter Schiff reveals why stealth QE may already be far larger than the Fed admits publicly.
In fact, in many respects, the export prices are more important, because that 100% reflects U.S. inflation, whereas import prices can reflect the inflation our trading partners are experiencing. So this was it. This was a trifecta of bad news on inflation that drove yield prices higher and bonds lower. Plus, you got rising oil prices that are in this numbers, but they're not in the core numbers, which are lousy. But oil prices went up. They're going to continue to go up. Bond yields are going to continue to go up. The only thing that won't continue is gold and silver going down. In fact, they were making good progress until today. So took a big step back as far as the price is concerned. But again, I'm nowhere near recommending that Schiff Gold customers sell their gold or their silver. So the fact that prices came down and we're not selling doesn't bother us. But what it does do is create an opportunity to buy more. And if you don't own any gold and silver, shame on you, but buy some now. Take advantage. In fact, again, Schiff Gold is open 24/7 over the weekends. In fact, you can go to the App Store and download the Schiff Gold app, and you can buy gold and silver this weekend while it's on sale on the app. And you're buying it from people who are foolish enough to sell it because they don't understand that rising bond yields are not bad for gold. They are good for gold. The only yields that really count are short-term yields. If they were rising, that could be a problem.
Oil prices, bond yields, and export inflation all accelerated together this week. The same sequence that historically appears before confidence cracks in financial assets. As Peter Schiff points out here, markets are obsessing over short-term metals volatility, while ignoring the deeper inflation structure quietly reasserting itself beneath the surface. The contradiction is that rising yields are being treated as bearish for gold, even as they signal worsening monetary stress and declining bond credibility. For long-term savers, this is where temporary price weakness can become strategic accumulation territory. Next, Peter Schiff reveals why short-term rates matter far more than headline treasury yields.
But not if they're rising more slowly than inflation. Then it's not a problem. Then it's actually a benefit. Because if short rates are going up less than inflation is going up, then real short rates are coming down. And remember, it's the real rate that counts. The nominal is just for show. The real rates are for dough, right? And traders are just completely missing the forest for the trees here. But that is giving us an opportunity, giving my customers at Schiff Gold an opportunity. And in fact, if you're also taking advantage of the gold mining stocks, the gold stocks got clobbered this week. The GDX today was down 7%. GDXJ down 7.4%. On the week, the GDX was down 10.4%. GDXJ actually a little less, 10.2%. Year to date, both indexes are still up, but barely, up just 2% on the GDX and 3% on the GDXJ. That's less than the increase in gold and silver. You've got a great buying opportunity on Monday. Obviously, maybe it won't be as good if these stocks open higher, but you should be buying these things on Monday. You can't do it over the weekend like you can buy physical gold and silver. And by the way, if you haven't set up your T-Gold account at Schiff Gold, go to tgold.com, set up an account, and start filling up your wallet with some virtual gold and silver that you will need one day as a medium of exchange. But on Monday, you can go and invest in my gold fund or any gold fund or any gold stock. I mean, I'm obviously partial and biased to mine, but Adrian Day runs it for me.
If inflation rises faster than interest rates for another 2 quarters, conservative portfolios could lose purchasing power, even while statements show positive returns. Peter Schiff notes that real rates, not nominal yields, determine whether savers are actually preserving wealth or quietly falling behind rising living costs. Mining stocks dropping over 10% in a week while inflation pressures build creates the kind of disconnect institutions often exploit before retail confidence returns. Investors chasing headline safety may not realize they are locking in long-term erosion through supposedly defensive assets. Next, Peter Schiff exposes why gold miners may be pricing in fear while fundamentals point somewhere entirely different.
I think he's the best. That's why I hired him. I knew he'd do a better job than me. So I hired him to be my stock picker, and that's what you need. You need a great spot stock picker, especially in the junior miners, which is about a third of the portfolio. So I would recommend, EPGIX. That is the no-load ticker symbol. You can buy it at any discount broker. You can also buy the shares directly on the Europac site. Don't forget, though, there's a prospectus on Europac.com. Read it. Right? There's a lot more risk in buying gold and silver mining stocks than there is in buying gold and silver. But I also think there's a lot more upside. And so that's why I'm recommending it. It's the upside potential relative to the downside risk. And I think it's a enormous opportunity, especially when you get sell-offs like we got on Friday on good fundamental news. It'd be one thing if gold and silver and the mining stocks went down because there was actually bad news for gold or silver. No, they actually got great news. You couldn't have asked for any better news for gold and silver. I mean, it's lousy for the U.S. economy. It's lousy for the consumer. It should be lousy for the stock market. But investors haven't figured that part out yet. But, you guys don't have to figure it out because I already explained it. And so you could take advantage of it by buying. By the way, I know, there's some Bitcoiners that watch this and think, well, Bitcoin held up better than gold. Well, Bitcoin was down 3% today, so not quite. And on the week, Bitcoin was down 2.2%.
Markets punished gold miners on bullish macro news, while speculative assets still absorbed capital as if liquidity conditions never changed. According to Peter Schiff, junior mining sell-offs during strengthening inflation conditions often reflect emotional liquidation rather than deteriorating fundamentals, which is exactly why institutions accumulate when retail confidence disappears. The broader contradiction is that equity investors still trust growth narratives even as higher yields tighten financial conditions underneath the economy. For wealth preservation investors, volatility inside miners may represent mispriced opportunity rather than collapsing demand. Next, Peter Schiff unravels why crypto resilience could be masking a much larger speculative imbalance.
Which is not as bad as gold. But year to date, while gold and silver are still positive, about 5%, Bitcoin is down 12.5%. So Bitcoin is having a lousy 2026 after having an awful 2025. But you ain't seen nothing yet. I think the back half of 2026 is going to be a lot worse for Bitcoin and other crypto than the front half. But I think that's when gold could really shine. I think that Bitcoin and tech stocks, and in fact, the main thing that's been holding up Bitcoin is the tech stocks and the AI bubble. But a lot of air should come out of that bubble because the bond market should prick it. Yes, we haven't had a big reaction yet to a 5.2% 30-year and a 4.59%, almost 4.6% 10-year. But as we keep rising and we put more and more distance between 4.5 on the 10 and 5 on the 30, at some point that is going to prick this bubble and the air is going to come gushing out, not just of AI stocks, but of crypto and Bitcoin, because those bubbles are intertwined. They're all part of the same speculative mania and really being fueled in Bitcoin by MicroStrategy or strategy, excuse me. But that's also going to blow up, and their whole Ponzi scheme called Stretch may be the pin that pricks that bubble, which is part of the overall Bitcoin bubble that in large part is being driven by the leverage buying of Michael Saylor on the part of strategy. But anyway, that's it for today's Schiff Gold market wrap. Again, go to the website. You can see the address above my shoulder, schiffgold.com.
Tech stocks keep climbing even as long-term yields approach levels that historically choke speculative excess and liquidity-driven rallies. What Peter Schiff is highlighting is that Bitcoin's resilience may have less to do with monetary revolution and far more to do with leverage-fueled correlation to the AI and tech momentum trade. The official narrative frames crypto as independent protection from the financial system, yet its behavior increasingly mirrors the same risk appetite driving overvalued equities. Investors counting on diversification could discover too late that these bubbles are interconnected. Next, Peter Schiff reveals the leverage structure underneath crypto that few retail holders fully understand.
Take advantage today, Saturday, Sunday, almost 15% off yesterday's high in silver. You got to love that. Opportunity to buy. It's still a beautiful looking chart, massive breakout. Looks to me like we're headed much higher. Gold is very solid in here. It's almost back down to 4,500, not quite, but that's over $1,000 off the February high. I would be taking advantage of that. And tell your friends, if you've got friends that don't own any gold and silver, now's the time to get them on board. Let them also take advantage. A lot of people, may see those declines and get scared out of the market. Oh, I thought gold was supposed to be a safe haven. Nothing's a safe haven every single day, but gold and silver are safe havens. The increased volatility that we're seeing now is a function of the breakout. This is a consolidation with big volatility following major technical breakouts. The most likely resolution to these patterns is a resumption of the uptrend that preceded them to new highs. And so before we make new highs, back up the truck and load up.
Silver, falling nearly 15% from recent highs, triggered fear headlines. Yet institutional positioning often strengthens during exactly these violent consolidation phases. This is where Peter Schiff's thesis shifts from short-term volatility to long-term structural demand, because breakouts in precious metals historically become more unstable right before the strongest continuation moves emerge. Mainstream coverage focuses on the drop itself, while ignoring how rapidly debt stress, inflation persistence, and bond market weakness continue building underneath the system. Investors waiting for emotional comfort usually re-enter only after prices already reset dramatically higher.